Have you ever stopped to wonder what actually happens when you click buy on a stock? The reality is, the old image of a crowded, shouting trading floor is long gone. Today, our financial markets are run by something totally invisible and unbelievably fast: algorithms. These powerful computer programs are the new kings of Wall Street, and our guide to understanding this world is a really important report from the SEC itself. So let's pull back the curtain and see what's going on. Now, this isn't just some technical deep dive for finance nerds. This is the official answer to a direct command from the US Congress. They looked at the market and said, hey, are these super fast trading robots helping us, or are they putting our entire system at risk? So the stuff we're about to go through, it carries some serious weight.
Okay, before we get any further, let's just nail down this key term. Algorithms sounds really intimidating, right? But at its core, it's just a set of rules for solving a problem. Seriously, think of it like a recipe. You have a specific list of steps, and if you follow them exactly, you'll always get the same result. The only difference is, instead of baking a cake, these recipes are making complex trading decisions in the blink of an eye. To really wrap our heads around all this, we're going to follow a pretty simple roadmap. First up, what even is algorithmic trading? Then we'll map out the digital marketplace where it all happens. After that, we'll look at the good stuff, the incredible benefits, and then weigh them against the very real dangers. And finally, we'll see how regulators are trying to keep this whole thing from spinning out of control.
All right, let's jump right in. Section 1. What are these algorithms actually doing all day? Well, you can think of them as the invisible engine that powers modern finance.
You know, the most important thing to get here is that these algos are just automating the same questions human traders have been asking for centuries. What do I trade? What's a good price? How many shares? Where should I send the order? The algorithm just takes in a fire hose of market data and, based on its programming, makes all those decisions at speeds that are completely inhuman. It's not one thing, it's a whole ecosystem of automated choices. Okay, so we know what they're doing, but where is all this high-speed action taking place? It's definitely not on a single trading floor anymore. The modern market is more like a fragmented digital battlefield.
And this is where it gets really interesting. Look at this chart. The SEC's data shows that about 65% of trading happens on public exchanges that we've all heard of, like the New York Stock Exchange or the NASDAQ. But check this out. A massive chunk, over a third of all trading, happens off exchange. So what does that even mean? What's going on in that other 35%?
Well, here's the key difference. Public exchanges are transparent. They're like an open book where you can see all the buy and sell orders. But these off-exchange venues, which often get called dark pools, they don't show their cards. The orders are hidden, or dark, until a trade is actually done. The whole point is to let big institutions, like a pension fund, trade huge blocks of stock without tipping off the rest of the market and sending the price haywire. So you might be wondering, why on earth have we built this unbelievably complicated system? Well, for all its complexity, automation brings some pretty huge benefits to the table.
And what's really fascinating is that the benefits are felt all over the place. For everyday retail investors, automation can lead to something called price improvement, where you actually get a slightly better price than what you saw on your screen. For the big fish, those institutional investors, algorithms are absolutely essential for breaking up giant orders to avoid causing waves in the market. And for the market as a whole, the insane competition among these high-speed firms has actually squeezed the bid-ask spreads. That's the tiny gap between buy and sell prices, making trading cheaper for pretty much everyone. A huge part of this automated world is high-frequency trading, or HFT. But it's not all one thing. It really has two different faces. On one side, you have passive market making. These are algorithms that are constantly quoting buy and sell prices, adding liquidity and stability to the market, and making a tiny profit on the spread. But then you've got the other side, more aggressive strategies that use their speed advantage to jump in front of orders or exploit tiny glitches in the market's plumbing for a quick profit. One adds stability, the other can introduce a whole lot of risk. And that brings us right to the dark side of all this. Because with incredible speed comes incredible risk.
I mean, really think about it for a second. This is the question that must keep regulators up at night. Because in a market that moves at the speed of light, one tiny error can spiral into a catastrophe before a single human even has time to react.
$460 million. This isn't just a hypothetical. This really happened. Back in 2012, a firm called Knight Capital rolled out some new trading software. But there was a bug in the code. That bug caused one of their algorithms to go completely rogue, flooding the market with millions of orders it never should have sent.
In just 45 minutes, the firm lost over $460 million. A single glitch nearly wiped them out.
So that Knight Capital story is a perfect, terrifying example of an operational failure. But the SEC report flags other big risks too. There's the danger of liquidity withdrawal. Think of the 2010 flash crash, where the market just vanished. In times of stress, all these algorithms might just decide to stop trading at the exact same time, causing prices to completely collapse. And then there's the constant arms race for speed, which creates this huge information gap between the fastest firms and, well, everyone else.
So when you're faced with all these new, complex, and frankly scary risks, how do the referees of the market even begin to respond? Well, they've had to build their own toolkit of automated defenses. To stop a panic in its tracks, they've got market-wide circuit breakers. To stop a single stock from going wild, they use the limit up/limit down plan. To prevent technical meltdowns like Knight Capital, there's Regulation SCI, which makes sure the market's plumbing is tough and secure. And finally, to figure out what went wrong after a crisis, there's the Consolidated Audit Trail, which is basically a giant black box recorder for the entire market. Let's just zoom in on one of those for a second. The market-wide circuit breaker is essentially a giant timeout button. If the S&P 500 suddenly drops by 7%, a level 1 breaker trips, and boom, everything stops for 15 minutes. It gives everyone, both human and machine, a moment to catch their breath, reassess, and hopefully stop a panic from turning into a full-blown meltdown.
And all of this brings us to the final and maybe the most important question of all. The market is a technological arms race. Firms are always getting faster, their algorithms more complex. Regulators are building some really sophisticated defenses, but a lot of them are designed to prevent the last crisis from happening again. It really makes you wonder, in this insanely fast world, can the rules of the road ever get ahead of the technology, or is regulation always destined to be playing catch-up?